Brent and WTI crude both seeing their worst week since October 2023. Brent plunging almost 10% this week, while WTI fell 8%. And today, BofA cutting its 2025 oil price outlook due to softer demand dynamics. Francisco Blanch is behind the call. He's the firm's head of commodities and derivatives research. Francisco, great to have you with us. I'm going to go to that, the title of the note, because it sounds poetic and it's kind of cryptic. The red dragon's green turn hurts black oil. Can you unpack that for us?
Thanks for having me, Melissa. So it is a little bit poetic, I would say, yeah. Look, there's a lot of colors in the title, but unfortunately for oil, it's been more red than not, and part of it really is that we have a lot more supply coming from particularly the Western Hemisphere. Essentially, non-OPEC supplies are growing pretty quickly into next year. We have growth still from the U.S., but also Canada, Guyana, Brazil, Argentina. So we have a 1.6 million barrels a day of growth in supply for next year. And against that, we have a slowing demand picture globally. We believe global demand growth will probably be at around 1.1 million barrels a day. And that leaves us in a meaningful surplus. And of course, the third leg of this equation is what is OPEC going to do? And frankly, OPEC gave us the news overnight that they're going to be holding back on that production increase that they were hoping to accomplish when they set out the target of bringing back 2.2 million barrels a day in June, earlier in June this year, right? So those are really the three legs to think about.
Francisco, it's Tim. Thanks for joining us. I guess my question would be, I guess we're here to pick stocks. You're ultimately there to forecast the oil price. But a lot of times the move in an oil price forecast is a function of time, where we've gone in the year, where we expect it to be. At this point, we've got to upgrade because oil prices have been here. When you've hiked the oil price in the past, what's the impact? And ultimately, and again, we can read through, I guess we're supposed to do that on equities, but I just, to kind of see what the other side of this is. How significant is this move for you? Or is this a function of both the calendar and obviously the fundamentals you talked about on supply?
For us, I think obviously the spot price of oil is always going to be a function of supply, demand, inventory direction. The forward price is a little trickier to pin down because it's going to build out some expectations around what will happen over the course of the next 18, 24 months. But ultimately, I think the issue remains that, going back to the title of the piece, that China is not just embarked in a meaningful secular slowdown, I would argue, right? On top of what's been a really tough cyclical period with China facing tariffs from the U.S., from Canada, from other countries as they try to export those EVs. But really domestically, they're transforming the economy as well. So they have a negative headwind against the economy, but also they really have a lot of substitution. They're moving away from electric vehicles, into electric vehicles, away from internal combustion cars. There's more cars today, electric vehicle cars, being sold in China than ICE cars. That's about 51% to 49% for the first time ever. And then on top of that, you have trucks running on LNG and moving away from diesel. LNG, liquid natural gas, effectively frozen gas. And so all of those factors are eroding at the margin demand for oil. And that's why we've changed our view. We just think there's too much oil in the market. There's a surplus, and that's why prices are going to be a little lower. But there is still downside risks. $75 a barrel may not be the end of it if OPEC increases production here.